Live from New York City this morning. Good morning, good morning. Tons of bank earnings, regional and small, and then a ton of Fed speak, with equity futures negative this morning by 0.7%. The countdown to the open starts right now.
Everything you need to get set for the start of U.S. trading. This is Bloomberg, The Open, with Jonathan Ferro.
Live from New York, coming up, squeezing in a ton of Fed speak before the quiet period. Tesla pushing for more volume, sacrificing profitability, and Yellen on China. Security worries top economic interests. We begin with the big issue: surviving, not thriving.
Yes, the regional banking crisis has definitely meaningfully abated.
Larger banks have obviously posted some very good results.
The question here is, where are the next dominoes likely to fall?
We're always looking towards what the next shoe to drop will be.
And I don't think anyone's surprised by the earnings reports we've seen this morning.
The bad news is deposit flight.
The entire banking system is going to see their deposits shrink.
When the Fed raises rates, things break.
You are starting to see an economic slowdown.
The U.S. regional banks, if the economy slows, are still going to find that a tricky environment.
We're going to be seeing slower growth. We're going to be seeing weakness.
And of course, that's going to hit the U.S. regional banks.
So we're just watching to see what else could potentially come under pressure.
Let's get you the latest. We can do that now with Bloomberg's Shonali Basak. Hey, Shonali.
John, if the problem of yesterday was deposit flight, the deposit flight of tomorrow, the problem of tomorrow will be net interest income. You're looking at the banks of yesterday give up some of the gains. You're looking at a lot of banks trading more weakly in the market today. The reason being you have firms like Zions, for example, missing on net interest income. Same with Comerica missing on deposits as well as net interest income. You have the likes of Fifth Third also saying that net interest income will be lower in the next quarter. And really the question here is, if they're not lending, where does the lending come from? Is this a wholesale contraction here in the credit markets? If you look at the commentary, it's quite concerning to hear how many banks are talking about the risk aversion that they're seeing in the market. Some of these banks that you're seeing on the screen here are more heavily weighted to commercial real estate. Think the Comerica and Zions of the world here. But again, you even see some of the bigger regionals giving up some of their gains from yesterday. Fifth Third, Truist as well. Deposits are flat from where they were before. And even with them beating expectations, the question is quickly turning to profitability of these banks.
Shonali, can we draw some conclusions? I know we have First Republic on Monday. What's left that still needs to come?
Yeah, First Republic is the big whale in the room, although we have more regionals, a slew of them really into next week. The question is First Republic truly stable? And will they be stable throughout the entirety of the next quarter as well? Listen, one really interesting thing, John, that I'm hearing in the market here, I talked to a lot of bond traders last night because some of these bonds recovered as well as the stocks. And there were a lot of cautionary tales still drawn among large credit managers among whether you get into the bonds at these levels. It's interesting. You recovered on First Western Alliance from 56 cents on the dollar to 80 cents. And the worry here is, are you safe at that level?
Let's talk to a man who knows a little something about the bond market. Shonali, thank you. We can do that with Mohammed Al-Erin of Queen's College, Cambridge. He joins us through the hour. Mohammed, co-hosting, anchoring, whatever you want to call it. Good morning to you, sir.
Thanks for having me.
Thank you for being with us. Last Friday, you said to me, slam the table at the IMF World Bank meetings, very aggressive. You said it's not a banking crisis. And you were right, in many ways, it's not. I want to know, though, is it the beginning of a credit crunch? Would you go that far?
So I don't remember slamming the table, but I remember saying, can we stop calling it a crisis? This is not a crisis. It was tremors. I will disappoint you by saying this is not a credit crunch. This is a credit contraction. And there is a difference. A credit crunch is economy-wide. It has massive implication. A credit contraction has distributional effects. So we should be talking about the distributional effects. That's issue number one. And unfortunately, that's going to hit small businesses harder than big business. And then the second issue we should be talking about is what the numbers are telling us, which is certain models are incredibly pressured in a world of higher rates for longer. And that's the world we're in right now. So what these numbers are telling us in the NIMs, and then we're going to see the cost of doing business go up, and then we're going to see capital requirements go up. it's just going to be harder for those banks to operate in this environment.
It goes back to that phrase we used at the top of the hour, surviving and not thriving. A big question we've asked repeatedly over the last month, and we've all been trying to answer it. To what extent is everything that you've just described a substitute for rate hikes at the Federal Reserve? Can you draw conclusions on that just yet?
I think it's hard to draw. There will be some substitute, but as you know, the estimates go from 25 basis points to 200 basis points. I think 200 basis points sounds way too much. I think it's probably more in the 25 to 50. But remember, there's a time and consistency issue. This is going to play out over time, but we've got the inflation issues up front. So this is going to be, it just makes the Fed's ability to navigate this trilemma, price stability, maximum jobs, and also financial stability, that much harder.
So they've got to talk about the totality of the data, so to speak. You've got the traditional indicators, CPI, payrolls, GDP, all of that, and then you've got the banking stress. And we've been trying to work out over the last few weeks how much weight should you put on each. Would you de-emphasize the indications that you're getting from the banks right now and re-emphasize the inflation pressure that we've been so focused on for 12 months?
I think you've got to look at it holistically, John. So if you're a policymaker, you've got to look at it holistically. If you're in the marketplace, some of your emphasis on whether we're going into recession or not going into recession should shift to which business models, which business approaches are no longer viable in a world of higher rates for longer. Commercial real estate, that's going to play out. We have $1 trillion, as you know, that has to be refinanced in the next 18 months. A lot of this stuff is going to have to hit the marketplace. It's not viable. People are not going to be able to hold it. So focus much more, if you're in the marketplace, about the business approaches that are going to come under significant pressure.
As a policymaker, knowing that's on the horizon, do you have the luxury of waiting, of having some patience about all of this?
You know, if we had started early enough, and I hate saying this over and over again, if we had started early enough, we would have the ability to wait. But we're late. We know now, we have ample evidence that inflation is sticky. We have ample evidence that wage growth is still too high. So the Fed is in a box, and I can't see the Fed waiting. I mean, the big question is, what do they do after May? I'm pretty sure they're going to hike 25 basis points in May. And what do they do after that? And they have to have a strategic view. They cannot go just on data dependency.
The disinflationary process has begun, has started, was a phrase the chairman used a few times.
11 times.
Before SVB.
11 times.
It was pre-SVB in that news conference, and in his semi-annual testimony opened the door to a 50 basis point hike. Are we seeing this progress start to continue, the stuff that he identified? Are you seeing any sign of that continue? If you take the banking stress out of it, you look at PPI, look at jobless claims starting to move in the other direction. Is that progress for you? So absolute progress on the good side. You will see disinflation on the good side. The problem is what happens on services. And I'm focused much more on services than I am on goods. Goods will continue to disinflate to a certain level. The question is, when will services disinflate? And the evidence we have so far is they are nowhere near disinflating. They're still inflating quite robustly. So they've got a choice, and then they've got a big risk. The choice they're going to make after May is whether they should pause or not. They've implied, based on the median dot in their dot plot, and we can talk about the range of views of the Fed, but let's work with the median for now, just for the purpose of this conversation. One more hike and wait. And you said pretty clearly, you've made it very simple, there's 3 scenarios here. Pause, and then you pause. You wait through the rest of this year. You pause, and then maybe you cut. Or you pause, and then maybe you have to start hiking again. Of those 3 right now, where are you leaning? So I can tell you what I think the Fed will do. The Fed will hike in May, then it will pause. Okay, and then we're going to have a real question as, is this an anchored Fed strategically, or is it this continues to be a flip-flopping Fed? And I hope that this Fed gets anchored. You know, my view, and Secretary Yellen's comments are going to reinforce this view, is we're living in a world of deficient aggregate supply. The supply side is not as elastic as it used to be because of geopolitical issues, because of transition issues, because of companies looking for more resilience. So if you are anchored by that view, you will take a different approach to interest rates. The Fed is not anchored by this view as yet. And that's why you see the 2-year. You know, I smiled when I saw the New York Times, of all newspapers, the New York Times talking about the bond market and calling it bonkers. Yep. And it has been bonkers. Look at the 2 years. Look it's moving again today. You've said this Fed is too data dependent. Is that what you're saying right now? Excessively data dependent. It has to have a longer term view. It has to be anchored by some strategic view of the economy. Of course, it's a gamble, but without that, even cash management becomes really hard. Just, again, look at the volatility in the 2-year. Well, the IMF's taken a view, haven't they?
They have.
They've said we're going back to the pre-pandemic world of low interest rates. Do you sense that's the Fed's view?
I don't know what the Fed's view is, and that's one of the problems. I don't know what the Fed's longer-term view is. It's interesting. I mean, Olivier Blanchard has taken the same view. You know, I am not there. I think we live in an economy that's supply pressured for the next few years. So I do not see inflation going down quickly. I do not see interest rate going down quickly. But those who simply extrapolate the past argue that this will happen.
Secretary Yellen, you mentioned those comments. Just to share that with our audience, if you are just tuning in, Secretary Yellen will talk about China at 10:15 Eastern Time this morning. So around about an hour from now, this is what the Treasury Secretary's had to say in some pre-prepared remarks, just a release of this one paragraph, this one quote. National security is paramount in our relationship with China. We will not compromise on these concerns, even when they force trade-offs with economic interests. We'll build on that a little bit later in the hour. Mohammed, you're going to be sticking with us, I'm pleased to say. Let's get you some movers going into the opening bell. There are many 20 minutes out from the opening bell. Here's Abby.
Hey, John. Well, I'm impressed that you've made it 10 minutes without talking about Tesla, but let's take a look at the shares of Tesla because they are, of course, dropping in the pre-market on a disappointing quarter. Profits were down 24%. This is as the company has reduced prices on its vehicles to spur volume demand. Margins hit, investors not liking it. Right now at pre-market session lows, down 8.7%. But it's not just Tesla weighing on the markets today, and it's not just the banks. We will take a look at some of the banks, but first, AT&T heading to its worst day since, I believe, July of last year. Free cash flow of $1 billion was light of the $3 billion estimate, but I think it's really the moderation of growth in their wireless segment comments that are spurring the weakness here. And then taking a look at the banks, Zion down 5%. This, of course, as deposits are moving in the wrong direction, both sequentially and year over year. And Key, their first quarter revenues missed. They've cut the fiscal year net interest income. These regional banks getting a bit hit today, John.
Abby, thanks for that. We'll stay on top of it going into the opening bell. Coming up on this program, a Russia Fed speak before the quiet period.
A bunch of Fed speak coming out, probably hinting towards one and done, which is our view, as opposed to, okay, well, the economy is now taking a second spot to political relations coming from the Treasury Secretary. There's a lot of confusion.
Waller, Mester, Bowman, Bostic, Harker, all on deck. That conversation coming up shortly. And later, SpaceX, once again attempting to launch its Starship rocket. We'll go there live as it happens.
The Fed obviously can raise short rates to whatever level they want to get to, but the more they raise rates, then they're going to have to defend that position and stay on hold for even longer. So the more they hike, they're going to have to try to at least maintain a position, because why cut 2 months, 3 months later, right? I do think the data will get weaker into the summer and into the fall, and so they're going to be faced with defending why they raised to begin with these last few hikes, as well as staying on hold at 5+%, which could then start to expose further weakness.
Fed officials dominated the calendar this week, delivering one message. The central bank isn't done hiking. New York Fed President John Williams weighing in on that. Inflation is still too high, and we will use our monetary policy tools to restore price stability. The May meeting now less than 2 weeks away, and it's a big final round of Fed speak. Today and into the quiet period, we'll hear from Waller, Mester, Bowman, Logan, Bostic, Harker, and Cook as well. Mike McKee, what a lineup.
It's murderer's row, as they used to say about Yankee Stadium. And I'll go back in time and say that John Williams is basically the E.F. Hutton of the Fed. The guy sitting next to you will know what I mean, certainly, because he's one of the top 3 Fed officials, and we're missing the second one, the vice chairman at the moment. So what he says is probably where Jay Powell is. And where they are is looking to raise rates one more time in May, 25 basis points. You can see the odds there. They've gone up to 90% for a quarter point move on May 3rd, which means the question now is what happens next after this? We go from what now to what's next, because the Fed doesn't really know what it's going to do. There's all kinds of various interpretations of where we are, except that there's a kind of unanimity about one thing. I mean, the Beige Book shows slowing economy and slowing inflation, but Fed officials this week are all emphasizing the fact that inflation is still too high. They probably could raise rates again if it continues that way, but there are risks to that. The full impact of Fed tightening hasn't hit. There is the possibility of a bank credit crunch, and the debt ceiling now becomes more of an issue. show this to you, and I know we'll talk about it later, John, but the Treasury cash balance not as high as they want it to be, pulls forward when the Fed has to start thinking about what it's going to do.
Mike McKee, we're going to return to that a little bit later, as you indicate. In about 20 minutes' time, we'll catch up with Anne-Marie and Mike McKee on that topic. Joining us now, Morgan Stanley's Brian Weinstein, Mona Mahajan of Edward Jones. Mohammed's still with us, I'm pleased to say. Mona, I want to come to you. Based on what we've learned from Shanali this morning and all the banks, regional, small and large, over the last week or so, how do you think that's going to inform the Federal Reserve in early May?
Yeah, it's an interesting question. And in fact, coming into earnings season, I think there was a lot of concern that we'd get much worse news on the banking front, whether it was large banks or the regional banks. And in fact, we've kind of gone through this last week and a half pretty unscathed here. Yes, there has been a little bit of deposit flight, especially from the regionals to the larger banks. But in fact, both large and regional banks have reiterated the message that, one, the consumer is pretty healthy. Two, there is no systemic risk really to the system that's imminent. And from a Fed perspective, really that probably does help them reiterate the message we've been hearing all this week and probably will continue to hear today, that they need to continue on this inflation battle. So I think certainly the Fed has two sets of tools that it can deploy if it needs to. It has its liquidity tools to address any potential banking crisis, but it also uses its monetary policy tool really to address the inflation issue. And I do think the 25 basis points that the market is essentially giving the Fed will take it, raise rates to that 5.25%. And from there, I do think they'll take some time to assess both the economy and the inflation situation going forward.
Mona, given what you just said about the uncertainty about what the Fed may do, the uncertainty about the economy, the different messages we're getting from the banking system, how do we reconcile all this with a VIX at 17? And normally we'd expect a VIX at 17 to be pushing more funds into risk assets. Have we seen that already, or are we yet to see this?
Yeah, it's a great point, Mohammed. We've been watching this VIX carefully as well. It's almost indicating a bit of complacency in the markets. And, you know, what I'd say is generally the markets had been anticipating a few big catalysts that maybe have underwhelmed. So the first was earnings season, and certainly it's early days still, but markets were really looking at, you know, potentially a negative 7.5% year-on-year earnings growth for the first quarter. Looks like thus far numbers are coming in much better than that, probably still looking at a negative 6.5% quarter or so, but earnings thus far have been a positive surprise. The second big catalyst was going to be this May Fed meeting, and in fact, looks like markets and the Fed may be converging toward this 25 basis point rate hike. There really has not been any meaningful indication one way or the other. And in fact, when we think about the economy broadly, markets are anticipating, it's, you know, kind of the worst kept secret out there, that we are heading towards perhaps a period of economic downturn, this mild recession that we've all been talking about. And so thus far, I think this complacency we've seen in the market is because we haven't hit any catalyst that would meaningfully deviate from market expectations.
Taking comfort from rate cuts and pricing them in too. Brian, I think that's the issue right now, and I wonder how you reconcile it. Markets priced in cuts and rallied. Can we price out rate cuts, and can risk assets rally still?
I think it's going to be difficult to price out rate cuts because, listen, what I think is bonkers was a 5% two-year note, right? I don't see any evidence that the Fed can or wants to stay up there. I think Mohammed said this very well. What are their indicators? What are we looking at? It can't be next month's CPI and next month's non-farm payroll number. So you look at this recession, which is in the Fed forecasts and in the staff forecasts. So to raise rates one more time, fine. You're tinkering now. There's no science behind 5 versus 5.25. What they're trying to do is go a little too high to prove a point, let the economy soften and come back down. So if I could lock in 5% for 2 years again, I would do it. We're locking in 4.20. I don't think it's a crazy level, and I think there are eases out there. I don't think know why. So is it good for risk assets? Not in the way they want it to be. I don't think it's a smooth transition.
Brian, I talked to Mohammed moments ago about whether this Fed had the luxury of being patient, waiting. When they start to wait, or at least want to signal they're going to wait and pause, they often start talking about long and variable lags. You expecting to hear more of that, Brian?
I expect to hear that phrase a lot, and I think it's accurate, right? We've had a very, very steep rate hiking cycle, albeit a little bit too late, no question about that. So they need credibility. But listen, I don't see anywhere in the bond market where the credibility is being questioned. Long-term break-evens look like the old regime, right? There's no inflation risk priced into the market. So the Fed seems to have won that battle for now. The idea that they can control the economy, ease a little bit, and keep risk assets together, maybe they can or can't, but the market seems to trust them. High yield looks okay, maybe loans look a little bit cheap, but I think they have a lot more credibility now than we talk about, outwardly, given what the market's pricing in. So that's where I come out on the topic.
So Brian, how do you reconcile in your mind long and variable lags with being highly data dependent? Highly data dependent suggests you react to whatever data is today. Long and variable lag implies that you really should be having a view on what the data is going to be in 9 to 18 months. How do you reconcile that?
Yeah. I can't. I'm just as surprised as you that they haven't moved away, that the dialogue hasn't changed, that they're focusing the market on things that are really lagging indicators, right? Owner's equivalent rent. Well, we can look at better indicators for rent. We don't need to look at next month's CPI to figure out that rental inflation has slowed down. Service inflation, as you point out, is even harder to look at. So I think they have to change what they're looking at. I'm surprised it hasn't happened yet. And I'm surprised we haven't heard the long and variable lags with an indicator pointing at something else. And hopefully it's coming, Mohammed. I don't see how we can continue to play this short-term data game, given we need to sit at 5% or 5.25% for a little while.
Mona, final word goes to you. Do you expect the Federal Reserve to abandon what Brian just called that short-term data game?
It seems like they will stick with that language of data dependent, but I do agree that they could start adding some indicators that do show more real-time indications. To Brian's point, housing and rental, it is lagged in the CPI data. There are more real-time indicators that are better. Even the labor market, it is a lagging indicator, not usually the first shoe to drop, usually the last shoe to drop. And so looking at, that wage growth component, there may be more real-time data, including jobless claims that they can point to. So certainly data dependent will stay in the language, but I do think that they have to start thinking about what's coming ahead in terms of this economic downturn.
Mona, Brian, thank you. As always, Mohammed, a lot of people on your page on this one at the moment. This is a big topic for you, isn't it?
It is. I think it's really important to give the market some sort of strategic anchoring. Otherwise, we are going to continue this dance, and it hurts. This volatility ends up breaking things.
Well, it's breaking the bond market in some ways, based on the volatility of the 2-year over the last month. Coming up on this programme, the morning calls, and later, sounding the alarm on Tesla's price cuts. Why Wedbush's Dan Ives thinks softer margins will continue weighing on shares. That conversation coming up. Plus, just minutes away from SpaceX attempting to launch its Starship rocket once again. 4 minutes away from the opening bell, equity futures deeply negative through most of this morning. On the S&P 500 down 0.7%. On the Nasdaq down 0.9%. Let's get you some morning calls. Truist first up, downgrading TripAdvisor to hold ahead of earnings, expecting a softer macroeconomic backdrop to weigh on lodging stocks. Their stock is down 3.4%. Jefferies upgrading GE to buy, growing increasingly optimistic about the company's aerospace business. And finally, Wedbush cutting its Tesla price target down to $215 after earnings, expecting margins to remain an overhang for the next few quarters. That stock is down by 8%. I have to say, Elon Musk this morning is not going to be looking at that. He's going to be looking at this. Another company, SpaceX, once again attempting to launch its next-generation Starship rocket after scrapping its first attempt on Monday. Ed Ludlow joins us now with more. Good morning to you, Ed.
Jonathan, £10 million of propellant have been loaded into the Starship system. If we clear the launch pad, this will be the most powerful, largest rocket launch system to attempt to go into orbit. 16.7 million pounds of thrust force generated, double what Saturn V achieved. And remember, Saturn V took man around the moon in 1968. This is the level and scale that we are talking about. 2 stages. The Super Heavy booster has never been launched, never been tested. The spacecraft, which sits on top, the shiny bit, has been tested 9 times, only landed after a high-altitude test successfully once. So there is a lot at stake here. The bar for SpaceX in terms of what success looks like, though, is very low. They want the data. At a minimum, they hope they clear the launch pad. But what they want to do is generate data from the engines, from the 33 Raptor engines. Hopefully at the 3-minute mark have the two stages separate, but there will be no attempt either way to recover either the Super Heavy booster, which is destined to fall into the Gulf of Mexico, and the spacecraft will hopefully orbit at around 150 to 250 kilometers above Earth for about an hour, come back down into Earth's atmosphere, and then splash down off the coast of Hawaii. Data, 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 but it's an expensive exercise, Jonathan.
Ed, how long before this takes off? What time is this launch?
This launch, we hope, is happening in the next 2 minutes. I actually have to defer to you, John, because I've got a tiny screen in front of me. So if you tell me what's left on the clock, we'll go from there.
I think it's got to be holding at the moment. Let's just look at the data. I haven't got the time either. Ed, you stay close,
Yeah, I see the
Ed.
hold now.
We've got a hold?
I see the hold, Jonathan.
We've got a hold,
yeah.
OK. Ed, what do you think that means based on that hold? Is that anything to be concerned about?
There are two windows for a hold. At the 6-minute mark, on most SpaceX launch systems, they allow teams that are not running in synchronicity to align with each other. There's often a second opportunity at the 40-second mark where they say, let's take a hold, look at the systems. It can be anything from various teams managing the launch running out of sync to the onboard computers detecting an error. I don't know what it is in this instance, but it's quite normal. So let's leave it. We can come back, and we're all hoping this actually goes ahead.
Ed, the launch window, just how big is that?
The launch window is 150 minutes. And remember that because of the air clearance required to do this, SpaceX is at the whim of the FAA. They have to manage airplanes, right, flying in and around the South Texas area. So there's a clear 150-minute window. It's normal for minute-by-minute delays. Remember when you and I were on television earlier in the week, they kicked it by an hour, then they kicked it by 20 minutes, and then they kicked it altogether due to a frozen pressurant valve. So anything could happen.
Ed, thank you, sir. We're going to come back to you a little bit later and return to those pictures if we do get another attempt at this. Another big step, of course, to taking people to the moon and beyond, and maybe even to Mars. Let's deal with the price action now. We're down about 0.8% on the S&P 500. On the Nasdaq, we're down 1 full percentage point. Equity futures are a whole lot lower. That's the opening bell. Let's get straight to the bond market. Yields look like this in the Treasury market. Your 10-year yield down 5 basis points, 353.94 in the FX market. Euro dollar firmer by 0.1%, 109.68. The big sector to watch at the opening bell, the financials. A host of regional banks reporting results after recording their best day of gains in a month on Wednesday. Shonali Basak has more. Hey, Shonali.
John, you have to take a look at the decline you're seeing already because you have KeyCorp, which is declining pretty significantly at the open here. Net interest income was not only below expectations, they're also saying when they previously expected an increase of this year, they are now expecting a decline. And you could take a look at it's one of the biggest decliners on the day. Something interesting to ask. A lot of your guests have been talking about the risks that are not baked into the market. If you look, provisions at a lot of these banks, provisions for loan losses have been ticking slightly higher, and they're higher than a lot of what estimates show on Wall Street. I looked ahead for you over the next couple of quarters also. They're expected to continue to increase into the year, except by not that much. If economic conditions deteriorate, then do those conditions become a bigger problem for these banks? I even want to point out American Express here because it's declining at the open, and they tend to have a wealthier clientele. The provisions for loan losses there topped $1 billion. That was well over what analysts were expecting. So are we quickly turning to how quickly credit can start to deteriorate here, even if you're thinking it doesn't fall into danger territory? Is the market not baking in the risk that it could really weigh on these banks in a bigger way at a time where you're also seeing the shift in funding mix as deposits continue to be under pressure?
Shonali, thank you. Let's stick with the earnings and move away from the financials and get to Tesla. That's been a big mover this morning. Price target cuts from the street rolling in just as fast as the company's own price cuts as concerns over margins grow. Abby has more on this one. Abby, this one's sinking all morning.
It certainly is. It's in fact having its worst day right now since January 3rd. And if you recall, at that time, the stock was around $100, really with no floor in sight. And then support kicked in. But today, not so much. The 47% year-to-date rally into today, a big chunk coming out of it. It has everything to do with what you were just talking about, concerns around margins. Margins being hit by about 200 basis points on the quarter, going below below 20%. This, of course, has to do with the fact that they are lowering prices between 15 to 30% on the various models, especially for the Model Y, closer to 30%, the Model S the least. And the question is, how much will this impact numbers going forward? They're making these cuts so that they can keep demand in place. Volume, it is likely, they're suggesting that volumes will stick around 1.8 million cars delivered this year. But right now, it seems that investors want both. They want the volumes and they want it to done so that margins aren't destroyed. Again, Tesla shares down about 8%, the worst day in about 3 months.
The broader market down about 0.7%. Abby, thanks for that. Dan Ives of Wedbush cutting his price target on Tesla to 215, saying this: with no rose-coloured glasses, margins are now a delicate issue that are keeping Tesla investors up at night. Dan, I'm pleased to say, joins us right now. Dan, did it keep you up at night?
A little. I mean, I think, 20% margins was really the threshold. They came in underneath that, and I think that's really going to be why the stock's down here. This is not what the street want to see from a margin perspective.
Well, we've got another launch elsewhere taking Elon Musk's attention. And this is it right now, a crucial step in the goal of taking humans to the moon and Mars. SpaceX attempting another launch.
Jonathan, we have liftoff. Starship, Super Heavy booster, and Starship spacecraft have cleared the launch pad. What you see on your screen is the most powerful launch system developed by mankind, heading out of Earth's atmosphere. 16.7 million pounds of thrust generated by the 33 Raptor engines at the base of the Super Heavy booster. 55-second mark, we hit max Q, the moment of the maximum aerodynamic stress or pressure on the rocket, working towards a top speed in orbital speeds of 17,500 miles per hour. This is unprecedented, Jonathan, what you're seeing on your screen. Remember, the goal here was very simple. Clear the launch tower, clear the pad. At the 3-minute mark, we expect the two stages, the Super Heavy booster and the Starship spacecraft, to separate from one another. The Super Heavy booster will then fall back down to Earth and splash down into the Gulf of Mexico, where it will sink. There will be no attempt to recover the Super Heavy booster. Starship, the spacecraft, will arc towards Hawaii and travel at an orbital height of 150 to 250 kilometers above the Earth for about an hour, perform a maneuver burn to come back into Earth's atmosphere, and then splash down 140 miles from the coast of Hawaii, 250 kilometers. They will not attempt to recover it. Jonathan Ferro in New York, Mohammed El-Arian as well. I don't know how to make this a confluence between markets, economics, and the future of mankind, but all I'll say is this is a ginormous moment for the space industry. And once again, Elon Musk has done what he said he'd do, later than he said he would, and broken a barrier when it comes to what's technologically possible for the space industry.
Ed, stay close. We'll keep running these pictures and follow this as it evolves. Dan Ives, I want to bring you back in. Elon Musk, Dan, never mind Tesla. Can you talk about this for a moment? What an effort by that man.
Look, I mean, incredible. And I think what he's done with Tesla, with SpaceX, just continues to sort of be the gold standard. And I think that's something that ultimately he's in this position of strength. And for Tesla, that's why it's also, just see with earnings, it's held to a higher standard because of what Musk has created.
We're going to return to those pictures in a moment, Dan. And for those of you at home following this, you can carry on following it in those pictures on the screen right now. But Dan, you and I need to talk about Tesla. That stock is lower. Margins are an issue. Is it keeping you up at night, Dan? You mentioned in your notes that it might keep Tesla investors up at night. Is it something that you're concerned about? And I think what everyone wants to know, Dan, you're so bullish on this company, on the leadership from Elon Musk. We all want to know what would change your mind.
Yeah, look, I think it was a concern, no doubt. I mean, no rose-colored glasses, that it came under 20%. Now, look, right now they're going on the aggressive, going after market share, and I think that's the smart strategic poker move. But I do believe the next few quarters are going to be pivotal in terms of trying to keep margins around here. If you have more price cuts and this just continues to go down from a margin perspective, I think that would be a clear negative going forward. And that's why the stock's down here.
So Dan, think of Amazon early on, where the strategy was dominate, 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 put up barriers to entry to others. Would that work here? will we look back and think that this was a smart strategic move, or we will look back and think that this was silly, that you can't dominate this market?
Yeah, Mohammed, I think it's a great question. I think here they're essentially putting an iron fence around their install base. It's an EV arms race that's playing out across the board. And, it's hard to argue with Musk. I mean, essentially, Musk has been playing, he's been playing chess, others have been playing checkers. And I think what we're seeing here, it's the right strategic move for the long term, but in the near term, it's a rip the Band-Aid off moment. And this is going to be transitory, what we see with margins.
Let's just build on that a moment, Dan, and talk about multiples. What I want to buy when I have a name like this with a multiple like this one is a high-growth, high-margin business, not an EV arms race. Dan, does that not resonate with you at all?
Oh, look, it definitely does in the near term. I think if we sit here a year and a half, 2 years from now, and this continues to be the narrative, then no doubt. I mean, this will be a major problem from a multiple and from where the stock is. But I do believe that this is sort of a pivotal time, given the macro, to really go on the offensive, cut prices, and make sure in this sort of arms race that they put that what I'll call an iron fence around the install base. Because it is an important moment. It's almost a moment of truth for Tesla. And investors really are going to now have to navigate what margins look like the next 1, 2, 3 quarters.
Just want to get an update on that attempt from SpaceX, from Ed Ludlow on the West Coast. Ed, what have you got?
Not a completely successful mission, Jonathan. We were tracking at the 3-minute mark for the Starship spacecraft to separate from the Super Heavy booster. That did not happen. Basically, the full stack remained connected, and once it reached a certain height, the combined Super Heavy booster and Starship spacecraft started falling back down to Earth, rotating in midair. At some point, an explosion was visible at high altitude while the combined Starship system fell back down to Earth. In other words, it just didn't separate. But remember, you could see on your screen at one point SpaceX employees cheering, because simply clearing the launch pad is regarded as a high degree of success for SpaceX. This mission all about gathering data. This is just the start of taking Starship from a developmental system to an operational system. So we will hear more about the technical reasons why, but we got to a certain height. The thing didn't separate the 2 stages, and then it blew up. But my goodness, that was fun.
To your point, Ed, how do we define success today? And Elon Musk himself lowered the bar quite a lot over the last couple of days, didn't he?
Yeah, you'll remember that on Sunday night, he did a Twitter Spaces for subscribers only, where he just continually hammered that point. It may not happen at all, and even if it does, the principal concern was any damage to the launch pad or stage 0, because the launch pad is an essential part of the launch system. It might not be the rocket itself, but it is highly technical and expensive to develop. They cleared the pad. There wasn't any standing damage, so that in itself is a success. But the fact that they were able to get to such high altitude but not have stage separation, they will simply take the data generated, work out what went wrong. And what we're hearing from SpaceX is that allows them to plan a cadence of next attempts. We are still some way away, John, from this being sort of meaningfully operational, either carrying Starlink satellites into orbit or humans, which is destined for the back end of 2024 and beyond.
It's the first step of a much bigger, broader effort. Appreciate it, Ed, as always, and looking forward to the programme a little bit later this morning, or rather this afternoon, midday, the Tech Show. Bloomberg Technology, Caroline Hyde, Ed Ludlow. Looking forward to that. Dan, I just want to squeeze in one question to you, and then I'm going to wrap things up with Mohammed. Dan Ives, we talked about margins. What on earth is going on with inventory? Why would that be ticking higher as they're cutting prices?
Well, look, I think that is definitely a question that we see in the U.S. I do think China is really where demand is starting to tick up. And that's what I view in the next month or two. That inventory is ultimately going to come down. The price cuts have sort of stabilized. And that's why in 2Q and 3Q, that's what I view as sort of an inflection point in terms of where this volume margin story starts to take the next level.
Dan, appreciate it, sir. Dan Ives of Wedbush.
Thank
Still
you.
bullish on the name, but just bringing in that price target a little bit. Mohammed, great to have you with us this morning.
Thanks so much for having me.
A final word. What are you focused on now going into May 3rd with this Fed?
I'm just focusing on the narrative as to what happens after May 3rd and whether they can convince the market that their forward policy guidance is credible. You know, they've been pretty consistent on telling us what happens after May 3rd, which is very little. We're going to stay there. The market and all the narrative is that's not going to happen. We've got to have these two things converge one way or the other.
Well, the data and time will take care of that at some point. Mohammed, fantastic to catch up with you, sir, as always. Mohammed Al-Arian. Coming up on this program, Secretary Yellen preparing to deliver remarks on China economic ties.
We believe that it is an important bilateral relationship, the U.S.-China relationship, even as we're talking about strategic competition.
That conversation up next.
This is Bloomberg's The Open. I'm Lisa Mateo, live in the principal room. Coming up, Bank OZK CEO George Gleason. That conversation at 4:30 p.m. Eastern, 9:30 p.m. in London. This is Bloomberg.
We believe it's important to maintain open lines of communication with China. We believe that it is an important bilateral relationship, the U.S.-China relationship, even as we're talking about strategic competition with China. And so that has not changed. We're going to continue to move forward in that way.
Secretary Yellen taking a spotlight in Washington, delivering a speech at 10:15 Eastern Time on economic times with China. Writing in a prepared remarks the following: national security is of paramount importance in our relationship with the country. We will not compromise on these concerns, even when they force trade-offs with our economic interests. AMH joins us now in Washington. Morning, Anne-Marie.
Good morning, John. Well, I think what we're going to hear from Secretary Yellen is she's going to make very clear that regardless, national security interests are number one. Even if it means it wouldn't be the best decision, say, if you were an economist. That's the thing she's going to outline today. National security interests are paramount. She's also going to talk about really a more level playing field when it comes to the economies of Beijing and Washington, that she wants to set better guardrails when it comes to that economic relationship. And third, areas where you heard Karine Jean-Pierre, the president's press secretary, talk about where to engage. And on that, it's going to be climate change and also debt sustainability. And already, Jonathan, we're seeing this administration try to take a warmer tone on opening up an avenue for engagement. We saw that from Secretary of State Blinken at the G7 foreign ministers meeting in Japan. Also today, we have U.S. Ambassador to China having one of his first meetings with a senior U.S. official since February. So you could see potentially Secretary Yellen here is setting up for her own trip to Beijing.
AMH, and also I'd say this, just given who we're talking about here, the former Federal Reserve chair, we're seeing this Treasury Secretary transform into someone who is willing to put politics before economics.
Well, I don't think the Treasury Secretary would call national security interest politics. But to your point, and I really go back to the tension in the administration when inflation was very high last year, and they had a decision on their desk, and that was whether to ease some of the Trump-era tariffs or keep them, double down because of national security concerns and that leverage that those tariffs still would provide. And at the end of the day, the administration went with national security concerns, and Janet Yellen is coming out today, and she's backing that.
AMH, thanks for that. That's the latest from Washington. Just getting that headline that we can confirm, that we all basically saw, that SpaceX Starship exploded after a failed rocket separation. Ed Ludlow's going to cover that for you a little bit later. Also happening in Washington, the debt ceiling debate heating up, and it's the president versus the speaker.
MAGA Republicans in Congress are threatening to default on the national debt. They say they're going to default unless I agree to all these wacko notions they have. America is not a deadbeat nation. We meet our obligations.
Today, I'm proud to announce that we are introducing the Limit, Save, Grow Act of 2023. President Biden has a choice. Come to the table and stop playing partisan political games. Or cover his ears, refuse to negotiate, and risk bumbling his way into the first default in our nation's history.
Back with us, Mike McKee. Mike, we need to talk about this, don't we? I think we're all trying to gauge, based on the returns, the tax returns of the last week or so, where that X date might fall. Mike, where is it?
Well, right now it is at the beginning of June, and you know, John, there's an old saying in Washington that you shouldn't watch the sausage being made, but what happens if the sausage doesn't get made? That's the job for the Treasury and the Fed. Treasury keeping a closed mouth on what it would do. But for the Fed, we have some ideas looking back at what they had done in the past. Now, you see in the markets already some kinds of reaction. We got only $108 billion in tax money on Tuesday when it was tax day. The analysts I'd spoken to said we needed somewhere between 150 and 200 billion. And so if we don't get enough in the next couple of days, it looks like we're going to move up the date for what is going to happen. And markets are already reacting to that. There's a big kink in the yield curve now with rates at the 1 month level way down because everybody wants in on that because you know you'll get paid. But then you go farther out on the curve and they rise significantly because people don't want those securities because they might be disrupted. What is the Fed's going to do about it? They're going to have to discuss that probably at the May 3rd meeting if we are pulling forward the date of the possible default. And they, in 2013, John, met and discussed a number of different ideas, including repos, reverse repos, ways to basically keep the system going. They want to make sure that people realize that what they're talking about is keeping the Treasury market open, not helping the government fund its debts.
Mike, just one more thing on tax day. There was a delay for California. They got an extension. Do you think that plays into some of the smaller than expected numbers that we've had?
It probably does because the 108 billion came in much lower than people had anticipated. The thought was 150 wouldn't be a very good number. So we're obviously missing a lot of money, but would California make up $50 billion? Probably not. So unless we get some additional cash coming in, and there will be some over the next few days, then the date moves up. The question is, can they last until June 15th when quarterly tax payments come in? And that would maybe push it out till August. But right now, it's beginning to look like you got to take the 1st of June seriously.
Mike, thank you, mate. 1st of June. I wonder when this market starts to carry in a bigger way. Mike McKee there on the latest. Your broader market right now, 22 minutes into the session, negative 0.6% on the S&P and the Nasdaq, down 0.5%. In the broader bond market, yields are lower off the back of jobless claims data earlier. We're down 7 basis points on a 2-year to 4.17. On a 10-year, we are down to about 3.54. We're down 5 basis points there. Let's get you some sector price action. Here's Abby.
John, well, what's really amazing here is that 0.6% decline. It's the worst day in about a month. It really speaks to the slow melt-up that we've had. Not surprisingly, then, with this sort of a decline, we have most sectors, all sectors at this point, lower. Utilities down the least. That defensive sector, energy and consumer discretionary down the most, down about 1% or more. Banks in the middle, down 0.4%. On the year, though, it's all about consumer discretionary being higher, a piece of that being Tesla, which of course is down today, but higher on the year. The banks, though, down 16%, a real divergence there between tech and the financials.
Bit of weakness this morning at the surface level, at the index level. Abby, thanks for that. More broadly, we're down by about 5 or 0.6% on the S&P. Up next, your trading diary, a ton of Fed speak to round out the week. 25 minutes into the session, equities lower by 0.6% on the S&P. On the Nasdaq, recovering just a little bit. We're down 0.5%. That's the price action. Here's the trading diary. 10:15 Eastern. 20 minutes from now, we'll hear from the Secretary of the Treasury, Janet Yellen, on US-China relations, plus Fed speak. Waller, Mester, Bowman, Logan, Bostic, Harker throughout the day. Rounding out the week with US PMIs on Friday, going into the quiet period for the Federal Reserve. Looking out to next week, more earnings on deck. First Republic on Monday, followed by Alphabet and Microsoft on Tuesday. On Thursday, Amazon and Intel report, and we get another US GDP report. From New York City, that does it for me. Thank you for choosing Bloomberg TV. This was the countdown to the open. This is Bloomberg.